In a financial world dominated by billions of dollars, high-profile analysts, and cutting-edge technology, a surprising reality emerges. Over 2 decades, 92% of professional fund managers fail to outperform a simple index fund that you can easily purchase from your phone in just 5 minutes. This is backed by data from the S&P Spiva scorecard, a respected benchmark in the finance industry, revealing that the majority of active managers consistently underperform the market. After 1 year, 60% underperform. After 5, that number rises to 75%. And after 10 years, an astonishing 85% are outperformed by the market. But it gets worse. After 20 years, 92% of these supposedly elite professionals fail to beat simple index benchmarks. These are not amateurs. They are highly educated experts, often Ivy League graduates with vast experience and substantial research budgets, yet they still struggle to deliver competitive returns. The question is, why? Two primary reasons stand out: market efficiency and high fees. In essence, markets are incredibly efficient. This means that any public information affecting a stock's price is factored into its price almost instantaneously, making it nearly impossible to consistently outsmart other investors who are analyzing the same data. The second reason, and perhaps the more significant one, is the impact of fees. Every trade made by an active manager incurs costs, as do the salaries of analysts and the expenses associated with lavish office spaces. All these costs detract from your total returns, leading us to the main antagonist in investing: the fee trap. On average, actively managed mutual funds charge about 1% annually, while index funds often charge just 0.03% or less. This might seem like a negligible difference, but let's look at the long-term effects. For instance, imagine investing $10,000 over 30 years with an average market return of 10%. If invested in an index fund with 0.03% fees, your investment would grow to $171,119. If you chose an active fund charging 1%, that same amount would only grow to $152,203, a difference of $19,016, lost merely to fees, not due to bad investments or market downturns. Now, expand that scenario to $500 monthly contributions over a 30-year career, and the fee difference escalates to over $200,000. That's a staggering $250,000 that could have been added to your retirement savings, instead funneled into the pockets of fund managers. Warren Buffett argues this point emphatically, famously betting that an S&P 500 index fund would outperform a collection of hedge funds over a decade. He won that bet decisively. So, what is an index fund, you might ask? Essentially, it's a collection of stocks that replicate a particular market index. The S&P 500 is perhaps the most well-known of these, comprising the 500 largest publicly traded companies in America. By purchasing an S&P 500 index fund, you invest in a tiny portion of all these major companies, spreading your risk across a diverse array of stocks. This diversification means that if one company faces difficulties, others are likely to perform well, stabilizing your investment. Historically, the S&P 500 has averaged about 10% annual returns, recovering from crashes and recessions time and again. Notably, over any 20-year period in its history, it has never recorded a loss. Let's look at 3 of the best index funds available now. First, there's VOO, the Vanguard S&P 500 ETF, which boasts an expense ratio of just 0.03%. For every $10,000 invested, you pay a mere $3 annually. Next is FXAIX, the Fidelity 500 Index Fund, even cheaper at 0.05%, only $150 annually per $10,000 invested. Lastly, we have SWTSX, the Schwab Total Stock Market Index Fund, which also charges 0.03% and offers broader exposure beyond just the S&P 500. Getting started is simple. Step 1. Open an investment account with platforms like Fidelity, Vanguard, or Schwab. It takes about 10 minutes. Step 2. Deposit your initial investment amount, whether it's $50, $100, or more. Step 3. Purchase your chosen shares, and step 4, arguably the most crucial step, set up automatic recurring investments. Even $50 a week adds up, a method known as dollar cost averaging. This strategy allows you to invest consistently, regardless of market fluctuations, and over time yields impressive results. For instance, committing $50 weekly at an average annual return of 10% could grow to $867,000 over 30 years. In summary, index funds are a low-cost, effective investment option, consistently outperforming the majority of professional strategies. In just a few steps, you can start your investment journey. Your task this week is to open an account at Fidelity, Vanguard, or Schwab and purchase your first share of an index fund. Just one share to begin. Let's take action together.